You're listening to the Weekly Wrap-Up on Sprott Money News.
Welcome back to the Sprott Money News at SprottMoney.com. Weekly Wrap-Up. It's Friday, June the 11th, 2021. I'm your host, Craig Hemke. Joining us this week is a return visit from Paul Wong. Paul is a market strategist at Sprott Inc. So we're going to get into some of the kind of the big picture stuff today, and that's very important because I know a lot of this minutiae, day-to-day stuff can really shake you off if you watch it too closely. We got to keep our eye on the big picture, and that's what Paul does. Paul, thank you so much for your time.
Thank you, Craig.
Hey, before we get started, I like to do this every week because there's all this great content that Sprott Money puts out, whether it's these weekly wrap-ups, the monthly projections with Christopher Mueller and the Ask the Expert segment, all of that, other great writers that post information at Sprott Money. Look, throw us a bone, throw them a bone. They do put this out there for you. So be sure to visit SprottMoney.com. And with summer right around the corner, why not treat yourself during the Sprott Money Spring into Summer sale? Hey, how about that? I know it's summer where I live. And Paul was just telling me it's summer where he lives too. From June the 7th through June the 28th, and while quantities last, you can take advantage of some great summer prices. Check out the featured products at SprottMoney.com, and you can buy them directly online. But if you want to talk to a human being, maybe kind of go over things in more detail, maybe try to find an option as to where you store your precious metal, you can always just pick up the phone, give Sprott Money a call, 888-861-0775. Sprott Inc., though, is where the investment action happens, and Paul, as a market strategist, is all over that. You can find his work at the Sprott website. He's got a great monthly highlights letter that he puts out. The most recent one, Paul, you talked about strong tailwinds for the precious metals. Yesterday, some pretty extraordinary CPI data. I mean, even the watered down CPI, Paul, geez Louise, are now 5% annualized. About those tailwinds, how has that picture changed even in just the last few days?
Well, Craig, yes. So in my monthly commentary, I guess there's four factors that are driving gold, supporting gold, and likely to push it higher into the future. U.S. dollar, real rates, M2 growth, and as you mentioned, inflation. So we'll just touch a bit on inflation. So right now, inflation is running hotter than expected, so the numbers came in a little bit higher than expected. The month-over-month increases is still, it's a bit eye-catching still. This month, it was 0.7, April was 0.9, and those are probably two of the highest back-to-back months, probably in about 30 years maybe.
Yeah.
And I guess why it stands out is, okay, if you go year over year, okay, you get the big base effect. So a year ago, pretty much the U.S. economy was shut down. Everything was pretty much ground down to a halt. So this year versus last year, all numbers are going to look extraordinarily good. But the month over month, you shouldn't have any of that kind of base effect because you're just looking, April over March, March over February. Mm-hmm. And those numbers are quite high. And I guess is it simply just, the economy restarting all at once, huge supply-demand bottlenecks that need to be reconciled and everything comes back down? Or is there something more sustainable going forward? And that's the problem. If you look at the long history of forecasting inflation, it's really poor. Whether you're talking about market participants, economists, it doesn't matter. If you look at any forward expectations numbers, and then you go and then you take it and you look at what inflation actually realized, the numbers are, to be blunt, are terrible. Like the numbers are all over the map. So you have a data series that's incredibly important to the market, has huge implications for valuations, PE multiples, discount rates, etc. But at the same time, you have a really difficult time trying to forecast that. And then you throw in the effects of COVID on top of that. Yeah. So what normally is exceptionally hard to forecast becomes even more difficult. So that's the problem. The problem you have now is that, okay, what if I'm right? What if I'm wrong? Okay, what if, okay, the Fed says it's transitory, and I think the consensus most economists you read is, okay, it's transitory. I guess the first question you have to ask yourself is, hey, what does even transitory mean? Are we talking months, quarter, a year, maybe more?
Yeah.
I mean, because, okay, inflation itself may be transitory, but the capital market reaction may not be transitory. And that's part of a bigger story that I tried to touch on in the article. So for the last, 10 years or so, decade, you've been sort of in this, I call it the Goldilocks slowflation type world.
Right.
Very modest growth, very little inflation. And so it's been going on for a number of years. And again, there's I wrote in the article how, all these different fund strategies, they latch on to this overriding macro theme. And over the years, they amplify it. They put bigger positions on. They leverage it up, et cetera, et cetera. And so now we reach the point now where, okay, well, maybe that may not work. Maybe it's changing. Maybe we're going through this regime change. Like for the last 10 years, everything that we thought, the market was going to do, all of a sudden gets turned on its head. And the market goes through these macro changes, seems like every 10 years. So, 10 years ago this time, back in 2011, the big overriding investment theme for that, prior decade was, the China-led commodity boom. And it was fantastic. That was, probably some of the greatest commodity markets ever, from what I can tell, like very limited data, but it's probably the best since the 1950s, post-World War II Reconstruction. Before that, at the end of 2000, you had the technology boom. So for the 1990s, the big technology wave, birth of the internet, technology-driven productivity gains. That was major cause of the big multiple expansion you saw in the marketplace. And that ended in a spectacular manner with the big technology crash. But, again, every 10 years you go through these big changes, macro changes. At the beginning, I remember every cycle quite clearly. It's always, okay, is it happening? Is it not happening? And then through time, a few years it evolves and it becomes clearer and clearer. But the one thing that stands out every time is that if you're not positioned correctly for the big macro change and you hold on to the prior regime winning strategy, typically it tends to be the worst performing strategy because typically that whole shift in the whole shift in macro regime, it's literally, it goes from day to night. And if you're positioned incorrectly, you can get hit pretty hard. So I wrote, that's kind of why, gold is such such a key asset. So if you're running like a multi-asset portfolio, gold all of a sudden starts to make a lot of sense. Okay, if I'm heading towards inflationary time, bond yields are probably, bond market's not going to do too well. The report, I just showed that since, late 2015, gold's been outperforming bonds at, I believe about over 8% annualized compound since then. But in inflationary time, it adds something unique. It gives you inflation protection. Again, this is the challenging part. Okay, so when inflation takes off, I mean, you don't really know what level of inflation you're talking about. Are you talking 2 to 3%, 3 to 4, 4 to 5?
Yeah.
That's the challenge because as you creep higher and higher, the downside risk becomes greater and greater. And again, it's not a linear progression. It's not like, okay, well, if I go 2 to 3, that's not that bad. If I go to 3 to 4, that's just a little bit more. But it's not. It's not a linear progression. The risk amplifies from that point. So I'll give you a case example. Let's say, I don't know, let's 6 months down the road, 9 months, 12 months down the road, all of a sudden, inflation's fully ingrained, and it's just awful. And the Fed has to slam on the brakes. It has no choice. Okay, they reach down, they try to let it run as much as they can, give it as much leeway as they can, but they realize, okay, we got a problem, and decide to slam on the brakes really hard. problem this cycle versus any prior cycle, it's that debt to GDP ratio. You're sitting around 130% debt to GDP, so you're in a very, very leveraged environment. And so, you don't have to be a macro strategist to figure what's going to happen. It's like any other business where you're over leveraged and all of a sudden your revenues, start coming down hard. You're caught in a trap. And so with that, all of a sudden your risk comes into the portfolio very, very quickly, especially tail type risk. So, if I'm running with that kind of debt to GDP ratio, that kind of leverage in the financial system, you kind of, the probability of a financial stress event will happen. I mean, it may not happen in the U.S. My guess is it'll probably happen in the emerging markets first, but it always bleeds back. There's always that contagion effect. It's been around for decades now because global economies are intertwined, markets are more intertwined than they've ever been, and so all of a sudden you have this tail risk event. And that's the advantage of gold. So when inflation goes high into moderate high level, okay, you get some inflation protection. But when it gets really high, then you start to tack on not just inflation protection, but tail risk protection as well. And in terms of hyperinflation, we're not calling for that. We don't know what's going to happen, but it's a risk, right? I mean, it's all about risk management in a portfolio. In a hyperinflation world, there's very little that gives you that kind of protection compared to gold. Because commodities will do well in a moderate inflation world, but when it goes hyper and you throw in financial stress events, commodities tend to get crushed.
Before we get to that point, do you sense this move in the last 12 months? I mean, again, I mean, a lot of it's unsustainable. Iron ore, lumber, soybeans. I mean, just go down the list. But do you sense this is just a coming out of COVID commodity surge and thus transitory? Or is it another one of these decade type shifts into a more secular commodity bull market until, we get some other event?
Not quite certain. That's the problem, right?
$1 million question. That's
the $1 million question, but it's not a binary question. It doesn't have to be a yes or a no. Mm-hmm. It can actually. I believe that it will become a yes, but not but it won't happen overnight. It's a progression towards yes. How's that? I mean, that's kind of a wishy-washy answer, but that's typically how it works in every cycle. It's never clear. Right now you have ample evidence that inflation will be transitory, and you have ample evidence that maybe it's not. It may not be transitory. But I think from a marketing positioning point of view, I think most funds they're just not built to handle an inflation transition because of the prior 10 years I mentioned earlier. All this layering on of these long duration assets, expectations of low growth, low yields, low inflation, low everything, and all of a sudden you switch literally overnight. It's going to be dramatic, and there's lots of reasons. COVID I think is the great, it's the great obfuscator of that data. Mm-hmm. But the transition right now is already occurring. I mean, in less than a year and a half now, you had $5 trillion of fiscal stimulus added to the U.S. economy. And that's without any tax increases. There's more coming. The infrastructure plan, the American Families Plan, that will have associated taxes. But $5 trillion has already been added. And just to give a rough estimate, before COVID, I think U.S. GDP was probably around $21.5 trillion. So 5 over 21, that's quite a bit. That's almost a quarter. That's the biggest spending wave, literally ever. And that itself. Okay, is that inflationary? Okay, by itself, it may or may not be inflationary, but when you add in the monetary side, the Fed basically launches what they call average inflationary target. So basically, they are literally saying we are going to engineer inflation. They want inflation. I mean, it's the old curse, maybe you get what you wish for, but they are actively, trying to generate inflation, because they want it to overshoot. Medium term, they say, okay, we want inflation. We want it north of 2. So, what's that mean? Okay, 2.5% for how many years? Like, probably more in a year, less than 5. You're talking about range. again, the Fed doesn't actually state what the numbers are. They actually don't give you a lot of reasons or a lot of numbers as to what they're looking for. It's more of a qualitative assessment, but they want inflation. At the same time, they launched a zero interest rate policy. So if you're trying to generate 2 to 2.5% inflation, your rate's at zero. Yeah, you have negative rates at 2 to 2.5%, and that's why the U.S. dollar is under pressure. That's why real rates are staying low. That's why gold is doing well. That's all part and parcel. So you cannot have high real rates if you're running 130% debt to GDP. You're trying to debase it, right? And the whole process is literally it's through inflation by target inflation, keeping interest rates at zero, create negative real rates, deep negative real rates, and stick it there. Make it stay for a number of years to erode it, and that's the reason why the dollar will have to go down.
Right. Which then benefits the commodity trade, but is also inflationary. Yep. And I'm sure you saw the latest, the whole budget projections going out the next 8 years that the Biden administration put out. All of them had negative real interest rates built into all their projections. So it's clearly where we're headed, and we know that's quite the significant correlation with gold prices long term. Paul, in our final couple of minutes, just if you don't mind putting on your Karnak hat and looking ahead, because next week is going to be all about the FOMC meeting that begins on Tuesday, wraps up Wednesday with what I call the Fed lines at 2 o'clock Eastern, and then Chairman Powell will have his press conference at 2:30, again, this coming Wednesday, the 16th. As you look ahead, you want to kind of, like I said, play Karnak and tell what you think. Tell us what you think he might say and what might come out of that, if anything.
Well, I guess everyone's looking for, this is weird, but yeah, they're looking for the talking about tapering. Yeah, and that's kind of where we are. Basically, it's this odd recursory function we have going in the marketplace. We're not even talking about tapering. We're talking about tapering. Everyone's trying to front run the Fed into figuring out what they're going to do and move ahead of time. But for gold, that the trade action you saw back in Q1, we already saw that gold took the brunt. That there was a tapering trade that was actually put on in the bond market and the euro dollar market, and that trade is actually over. That the tapering trade is actually, for gold especially, is already come and gone. I think it's already been discounted. If it's not been, not fully discounted, it's been majority discounted. And I think I wrote at the end of one commentary, I think the end of March, was that they fully discounted tapering. What they have not discounted at all is inflation. And of course, I think a few weeks later you had that really hot inflation print, and then gold does, it moves up dramatically in a very, very tight trade range up to 1900, and that's funds positioning the same funds that were shorting, selling gold for tapering. They switched around. They were buying it for the whole inflationary theme. So what to look for the Fed? Again, the market itself is fixated on the whole tapering notion, but for gold, I think a lot of that has already been discounted. So I would take any signs that the Fed is going to taper as I would take it with a big grain of salt, knowing pretty confident that the market has discounted a lot of that already in the bullion when it went down to 1670. I think the market again has not fully anticipated whether inflation is it truly transitory or not. And by the way, what level of inflation is it transitory? I mean, is that 2% transitory? Is 2% transitory? Is 4% transitory?
That part gets left out.
You get that silly notion. But so, just take away from all that. M2 is expanding right now. Right now, the 3-month annualized rate of change in M2, and the latest data point I think is only the first week in April. So that the latest, $2.9 trillion spending that was announced December and March it's starting to make its way through M2. So right now, on an annualized 3-month annualized rate of change basis, M2 is running at 20%. So that's twice the rate of the Great Financial Crisis, just a bit below the COVID, that March COVID, to 20 growth rates. So M2 is going to be exploding in the next little while. Real rates are suppressed, and chances are heading lower. U.S. dollar, I highlighted in one of my monthly commentaries, it's probably going to break lower. And once that happens, the market comes to, an acknowledgement, the Fed's serious about this whole inflation targeting and zero interest rates. And it's going to, this is how this is how the process works. It is a debasement. It is inflationary debasement of the debt. And that's how it goes. And then gold gets another re-rate, I think, at that point.
Sounds like a pretty good stew for long-term precious metals investors, that's for sure. And a lot of us that listen to these calls every week, that's what we are. So I want to thank you, Paul. Great stuff. Again, Paul Wong, market strategist at Sprott Inc. Guy's got his fingers on the pulse of that big macro, big picture, which continues to support the precious metals. And hey, again, don't forget, if you're looking for physical precious metal, anytime you're in the market, Sprott Money has got to be a site you want to check. And if you like this sort of information, please help us get the word out. If you're listening on a podcast platform or on YouTube or any place, please subscribe, maybe like the content, and that will help us cast an even wider distribution net to wake people up and get them aware of what's actually going on. Paul Wong, thank you so much for your time today.
Great. Thank you, Craig. Have a great one.
And from all of us at Sprott Money News and SprottMoney.com, thanks for listening. Have a great weekend.